Hi everyone, in this video we'll be going over A-Level Accounting 2023 May-June Paper 2-3 question number 3. This is paper 2 which consists of 4 questions. 2 of them will be of 15 marks and 2 of them will be of 30 marks. And the total time limit for this paper is 1 hour and 45 minutes. Since question number 3 is of 15 marks, ideally you should be spending about 17.5 minutes in order to solve this question. And in this video as well, we will be attempting to solve this question under 17.5 minutes. So without any further delay, let's get started. On 1st January 2022, the directors of J Limited made a bonus issue of 2 ordinary shares for every 3 ordinary shares held. So for every 3 ordinary shares in the company, we gave out 2 new bonus shares. And the following is an extract from the company's statement of financial position immediately after the bonus issue. So remember that this is after the bonus issue, which means that we have already included the bonus issue into our ordinary shares and we have already funded the bonus issue from our reserves as well. Now the directors financed the issue 60% from the share premium account and the remainder from the retained earnings. So what we know in this case is that this includes both of our ordinary shares as well as the bonus shares. And we know that we gave out 2 new bonus shares for every 3 ordinary shares. So from every 5 shares, 2 of them will be of bonus shares. So let's figure out the value of bonus shares in this case, because 2 out of 5 of this amount will be our bonus issue. So the bonus issue is just going to be the total amount of 1 million multiplied by 2 divided by 5. And this gives the bonus issue's value to be 400,000. Now out of this, we're told that 60% will be funded by the share premium. So 400,000 multiplied by 60% is just 240,000, which will be funded from share premium, and the remaining 40%, which is 400,000 multiplied by 0.40, which is 160,000, will be funded by our retained earnings. Now for the first part of this question, we need to prepare an extract from the statement of financial position immediately before the bonus issue, showing the equity section. So it's quite easy. So I'm just going to prepare the statement of changes in equity so that you can view it as you're used to. So we have share capital, we have share premium, and we have retained earnings. So the values we have will be before bonus issue, then we'll include our bonus issue, then we'll get the value after bonus issue. In this question, we were given the value after bonus issue, and the values were only for our ordinary share and the retained earnings, which means that our entire share premium account will be exhausted by the bonus issue. And we have 1,120,000. So that's 1 million in share capital. And we have nothing in share premium. And for retained earnings, we have 120,000. Now we have already calculated a bonus issue as well. So it will bring 400,000 to our share capital, which will be funded by 240,000 from the share premium and 160,000 from our retained earnings. Now we just need to figure out the values before bonus issue for the first part. And in order to do so, it is just going to be our balancing figure. So we just need to subtract our bonus issue from the total. So for share capital, that's 1 million minus 400,000, which results in 600,000. So that's the value that we need to show right here. For share premium, that's 0 minus 240,000. So that's a double negative, which makes it a positive. So that's going to be 240,000. Okay, I made a mistake here because remember that for bonus issue, we'll be subtracting from our reserves. So this should be a negative value. So for the opening balance or before bonus issue of our retained earnings, that is just going to be 120,000 minus 160,000. So that's basically 120,000 plus 160,000, which results in the value of 280,000. So for share premium, that should have been 240,000. For retained earnings, it should have been 280,000. So the total equity would have been 600,000 plus 240,000 plus 280,000, which results in 1,120,000. That's all for the first part of this question. Now let's move towards the second one. We're given additional information. GA Limited's financial year ends on 31st March. On 31st March 2021, the directors paid an annual ordinary share dividend of 20%. However, on 31st March 2022, the directors decided that the annual ordinary share dividend would amount to 0.05 per share. And Hassan is a shareholder in the company. He owned 7,200 shares before the bonus issue on 1st January 2022. Alright, so let's create a timeline right here. This is 31st March 2021. This is 31st March 2022. Somewhere in between, there's 1st January 2022. So, at 31st March 2022, Hassan had 7,200 shares. So, as per our annual ordinary share dividend, he would get 20% of these shares. So, the dividend at 31st March 2021 is just going to be the number of shares, which is 7,200, multiplied by 20%. And remember that he's not getting the number of shares, he's actually getting the amount, which means that we would have to figure out the value for our number of shares. So the nominal rate in this question is given to be 0.50. We just need to multiply it to the number of shares in order to figure out the value. So we just need to multiply it by 0.50 as well. And this gives the dividend at 31st March 2021 to have the value of 720. Now we just need to figure out the dividend at 31st March 2022. But remember that at 1st January 2022, we made a bonus issue. And the condition for our bonus issue was that for every 3 ordinary shares, we'll be giving out 2 bonus shares. So for every 3 ordinary shares, we were providing 2 bonus shares. For 1 ordinary share, there was 2 by 3 bonus shares. And Hassan had 7,200 shares. So for 7,200 ordinary shares, we gave out 2 by 3 multiplied by 7,200 bonus shares. That's a total of 4,800 bonus shares, which means that now the total number of shares for Hassan would be 7,200 plus 4,800, which is 12,000. So at 31st March 2022, he has a total of 12,000 shares. And at this date, the annual ordinary share dividend would amount to 0.05 per share. In order to figure out the total dividend, we just need to multiply the number of shares, which is 12,000, by the rate of dividend, which is 0.05. And this gives the new dividend amount to be 600. And in this question, we were asked to calculate the change in the amount of dividend. So previously it was 720, now it's 600. Clearly, there's a decrease. So the decrease is just going to be the difference. 720 minus 600, which is of 120. That's all for the second part of this question. Let's move towards the third one. We need to state 2 differences between capital reserves and revenue reserves. So the very first thing is that capital reserves arise from non-trading activities, whereas revenue reserves will arise from our trading activities. So capital reserve arise from non-trading activities because these will be our disposal of assets, which is not our trading activities. That's not the main activity of the business. Whereas revenue reserves arise from trading activities. These are just going to be our profit or retained earnings. Now, the second difference is that capital reserves cannot be used to finance cash dividends because we can only deduct the dividends paid from our retained earnings, which is basically the accumulation of profit, which can be categorized as our revenue reserve. So, capital reserve cannot be used to finance cash dividends, whereas revenue reserves can be used to finance the cash dividends. Alright, that's all for the third part of this question. Now for the fourth one, we need to state 3 reasons why the directors of a company might reduce the total dividends payable. So the first thing that we need to consider is that dividends is part of our profit. So if there is decrement in profit, then the company might reduce the total dividends payable. The first thing is decrement in profit. The next thing is that if we're paying cash dividends, we need to have enough cash in our company. So if there is a lack of cash or liquid funds, then the company might reduce the total dividends payable. So lack of liquid funds. And even if there are enough liquid funds, it might be required for some other objectives of the business. Maybe the business has an objective of growth, so it needs to reinvest in the company itself rather than paying out the dividend. So liquid funds required for other commitments. And these other commitments also means our trade payables or interest payables and so on. So this is the fourth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.